Dividend Capturing. My name's James Gardino. I live in Sarasota, Florida, where it's warm, sunny, beautiful all the time. Dividend capturing goes back all the way to the 13th century. We look here, we find an old share that was dated June 16th, 1288. The great Copper Mountain Mine has been taking copper ore out of the earth since the 900s. A clergyman traded in one of his estates for 1/8 of a share of the Great Copper Mountain Mine. It's worthy to note that the Great Copper Mountain Mine had closed its mining operation in 1998. That is over 700 years worth of profits from this one business venture. It's a nice little inheritance if you think about it. The stock market that we know as of today got its start in the 1590s, when a bunch of businessmen, Dutch businessmen, got together and decided they wanted to create the biggest company the world has ever seen. In order to do so, they had to go door to door offering shares of the company to the public. The very first share was sold in 1602. The Dutch East India Company, which ran for 198 years, averaged out an 18% dividend yield, which is a very good investment also. Now in 1607, the very first stock market was opened in Amsterdam. Now the United States opened up our stock market back in the 1700s. But let's continue. There are 4 key dates you need to remember when it comes to dividend stocks. The announcement date, that's when they let you know what's happening. The EX date is the last day the stock trades before they pay the dividend. The date of record, whoever owns the stock on the date of record is the person who's eligible for the dividend check. The payout date is just the date they actually write the check. Now when it comes to dividend capturing, it's very simple. Buy the stock before the EX date, sell it after the date of record for a small profit, then just repeat the process. Now as you can see, each month has an average of 20 to 22 trading days. That's roughly around 240 trading days a year. If we go over to FinViz, it gives you an idea of what dividend yields, which stocks are paying. As you can see here, a company paying a positive dividend, there's 3,001 stocks paying a dividend. 531 have yields over 5%, 101 have yields over 10%. Now, in a 2-week period, which is in December, just quickly to give you a rough idea, we got 40 stocks. We have 80 stocks. We have 120. We have 160. We have 200. We have 240, 280, 320, 324 companies all paying out a dividend, all profitable companies paying out a dividend to shareholders within this 2-week period. How do you find out which one's right for you? Well, dividend capturing, we have stocks that are categorized on how well they performed. The Dividend Kings, you see right here at the top of the list, there's only 17 companies, and they have increased their dividend payment for a minimum of 50 years just to make it to this list. And that's what a lot of companies are striving for. Now you get the Dividend Aristocrats, 52 companies that have a minimum of 25 years or more of dividend increase payments to their shareholders. The Champions is 125 companies, 25 years, and you have the Challengers with 160 companies, and the Dividend Contenders, 207 companies, and the Dividend Cheaters bringing up the rear with 5 years of consecutively increasing their dividend payments. Now, let's take a quick look at some of the Dividend Kings. You have Northwest Gas, you have Diebold, you have Procter & Gamble, Johnson & Johnson, Emerson Electric, Coca-Cola, Genuine Parts, Colgate-Palmolive, 3M, Lowe's. A lot of these companies are household names, and many of them are over 100 years old. They're all over 50 years old, we already know that. But some of them are over 100 years old. So these companies are well run and have been around for a long time. Now we take the Dividend Kings and we put them into our dividend calendar. Now this will tell us when throughout the year each company is traded. Now here the dividend calendar shows you there's 4 Dividend Kings trading in the month of January, 8 of them in February. See, 4 in the month of January, 8 in February, 4 in March, 4 in April, so on and so forth, all the way down the line. If you just wanted to trade once or twice a month, you can invest in just the Dividend Kings, double or triple your returns with just these 50-year consecutively increased dividend payment companies. Anyway, moving on. The Dividend Aristocrats, more than 25 years. Not quite to 50, but more than 25. You got Target, T. Rowe Price, Walgreens, Walmart, Granger, McDonald's, Lowe's, Hormel, AT&T. A lot of these are household name companies. Family Dollar, ExxonMobil. Anyway, let's move on. So the Dividend Aristocrats, you have these 54 companies. You plug that into the calendar and it shows you when throughout the year they're trading. January you have 13, February is 25, March is 25 also. February is 22, March is 25. Now that's just the first quarter, then the whole cycle starts all over again. The second quarter starts April, the 17, May is 22, June is 25. Now these companies, 25 years or more consecutively increasing. Solid companies. You know the names. They're household names. Okay. The Dividend Champions. Now these guys have just squeaked by with the 25 years. A lot of them, again, household names. You have Lowe's, Kimberly-Clark, Johnson & Johnson, Illinois Tool Works, H.B. Fuller Company, so on and so forth. But there's quite a bit of the champions. Now, all these guys, like I said, 25 years minimum of increased dividend payments. You have 24 in the month of January, 55 in the month of February, 45 in the month of March. April starts the second quarter, 29, 54, 44. The third quarter, 29, 55, 40. The fourth quarter, 32, 54, 45. On and on and on. There are so many to pick out of every month of good, solid companies. Okay. Quickly, we're going to put some of these companies into our dividend calculator. Now this calculator goes through and figures out how well these companies have performed over the last 10-year period. Let's take a quick look. CTAS, the stock price 54, the dividend is 19, the yield is 1.39. It's not the greatest in the world, but look at this. If you just wanted to collect the dividend, 100% of the time, you buy it before the EX date, you hold on to it till after the date of record, turn out, sell it for a profit. 100% of the times in the past, it has done what we wanted it to do. Does it mean it's going to do it again in the future? No, it does not mean that. It means there's a high probability that it might, because it did it so many times in the past. All the way down here, the top 20 companies. 3M, EMR, that's Emerson. A lot of these, Granger, Clorox, Raven, Walmart, McDonald's, Chubb. The numbers are just outrageous. Okay, so you have the dividend, the yield, the 20-day moving average, the 10-year performance, how well it's performed over the last 10-year period on a different strategy. But this is the dividend capturing strategy and how well it worked on that one. Now, let's look at the top 10. You have this one right here, 8% yield, almost 8% yield, almost 8% yield. RLI, 6.3, UHT, 5.9, UCP, 5.4, so on and so forth. You see these top 10 companies right here, over 4%. Okay, quickly, so it's going to look like on the chart. This is a 10-year chart of CSL, which is Carlisle Companies. If you take a look at where the dividend is right here. If you look, it didn't be, what's that, 4 or 5 days before you're called out, sell it for a profit. You buy it on the EX date, which is right here where the dividend is, and look, it goes up right here. Oh, you hold that for a couple of weeks, but you still get out with a profit right here. Still get out with a profit. Still get out with a profit. Again, still a couple of days later, get out with a profit. This one right here, you had to hold for a couple of weeks, but you bought it, turned around, sold it for a profit. Bought it, sold it for a profit. This one, another one, a couple more weeks. Bought it, sold it for a profit. Bought it, sold it for a profit. Bought it, what, a day or two? Bought it, sold for a profit. A couple of days, bought it, sold for a profit, bought it, so on and so forth. You see how it is. Walmart, the exact same thing. You buy it, turn around, sell it for a profit, collect the dividend. CSL, we just saw that one, didn't we? Yeah, CSL, Walmart, Chubb. Same thing. Buy it, turn around, collect the profit, collect the dividend. Anyway, it's a very simple strategy. You buy it before the EX date, you sell it after the date of record for a small profit, and then you just repeat the process. Stick to the companies that have been proven track record and have been paying out for a minimum of 25 years, and you have a good recipe to make a little bit of money on a very safe, well-tested strategy. This is James from the 10 Minute Trader. You have a great day.